Well, good morning, traders, and welcome to the world of earnings trading. So this Google trade kind of went off the rails. Google has not opened yet, but it's going to open down significantly based on their Q4 results. So I want to kind of show how I handle something like this when these things occur, because they will. So this is a calendar. Remember that I sold a 160 call here that expires on 2/2, and I bought a 160 call that expires on 2/9. Okay, so that's the calendar spread. Now, we're going to open this morning all the way down here around 142. Lots of heavy volume that's traded on this thing after hours. So, we're going to be all the way down here. This, 142 is about right there. The tent on this at the open, we're going to watch this. This tent is going to shrink up considerably. We will be at close to max loss out of the gate on this. So my game plan is this. What I'm going to do, these options that expire tomorrow on Friday, 2 days from now on Friday, are going to drop significantly in value. I sold these for $1.48. These could be worth a nickel or a few cents, something along those lines. In other words, this particular part of the trade, I will have been able to extracted close to maximum value out of on the open. Again, we'll take a look and see where that price ends up, but I have an order out there to close, to buy to close these 10 shorts for 3 cents. Again, allowing me to get close to max profit on those. Now, what's going to also happen, though, is our long here on 2/9 that I paid $1.45 for, those are going to drop significantly in value as well. Now, because we're dropping so far here, 20 points below, but these have a longer period of time. These don't expire until the 9th. So it's possible, the goal here is that these will not drop as much in value. Now, I have an order out there on some of these to sell some of them, not all of them, at 50 cents. I think that's unlikely. I don't think I'll be able to do that. But I'm going to place the order out there anyway, just to see. If that were to happen, if I were to be able to buy the other ones back for a few pennies, 3 cents, and if I were to be able to sell some of these for 50 cents, I would actually end up still getting some profit out of the trade. But I don't think that's likely to happen. But again, on these wild opens, when the market can gyrate all over, I want to have that possibility out there in case I can get a fill. So that's what we're going to look at. We're going to look and see at how these two differ, how these two vary upon the open here in just a few minutes. And again, our tent is going to shrink up considerably. I do expect that I will likely be able to get a fill on these, buying them back, creating almost full profit in the my short strikes. And this one, I really don't expect to fill right now, but I'm going to leave them in place. I'm going to see where they open. I'm going to leave them in place. We also have a Fed announcement today. There's an outside chance that that Fed announcement could move the whole market, including Google, back up. And if that does happen, then these longs will start to regain some value, and then I can decide what to do about them going forward. It's possible that I could come out to the 9th and I could sell a 155 call against that, or maybe a 157.5, or maybe even a 150 call against this, turning this into essentially a short call spread that wouldn't expire until next week. But I'm not going to go there just yet. I'm just thinking through my possibilities for managing a trade like this. So those are the things I'm considering at this point, and just wanted to kind of show how somebody might think through those different possibilities. I'm going to pause here right now. I'll be back at the open, and we'll see what actually happens on these two strikes when we get to the open. Okay, so we're going to open up in about 15 seconds here. This will not update probably right away. It'll take a minute or two for the Market maker to get the desk open. There's the open, and I've got orders firing off here. And let's just see what the price here on this one did do. And yeah, it dropped down to a penny. So that order was probably filled for 3 cents. Now let's see what happened on this one. Since that one dropped down to a penny, this one will have dropped way more than 50 cents, I'm sure. Yeah, it dropped down to 5 cents. So it's essentially going to be a max loss trade. What I'm going to do here is I'm going to leave these. So these don't expire until next Friday. There's no sense in me selling them. I can pick up 4 cents. So I'm going to leave those intact and see if we might in fact get some sort of a rally in Google back up into that 150-ish range or so over the next few days. And if that were to occur, then I can sell more short strikes against this in order to attempt to recoup some of the loss on this trade. So now that I know that I've made essentially the maximum amount that I can make on these short strikes, let me show you closing these out. So I want to come here, I want to buy to close, and in my case, I paid 3 cents for them, so I could buy them actually for probably a penny right now. But I closed them for 3 cents, so I'm going to hit buy to close. And now you can see I have no more downside risk. I've kind of experienced the maximum amount of downside pain that I'm going to experience, but I do have an outside chance if the market were to move back up, that those long calls could still move into some profitability. Now, it is a very outside chance. I want to be clear on that. But even if the market just moves up a little bit, if the market moves up to 150, 155, somewhere in that general vicinity, I could potentially come in, and let me just show you what it would look like if I were to sell a call. I would do it on that same expiration, and maybe I could sell a 150, a 160 call, something along those lines. Or excuse me, not a 160, because of course that would cancel out the one that's there, but a 150, 155 call. So right now I won't get much for that, but let's go closer to the money. We're trading at 143. So if this were to run back up to, let's say, the 145 range or so, 144 range, I could potentially sell this call for decent money, $1.82, somewhere in that general range. That would then give me a significant amount of potential profitability. I do not want to do this trade right here where this is, because that's a 15-point spread on a 10 lot. That's a lot of pain. That's $15,000 in pain if Google did go hard against me to the upside. So I really only want to consider this if the market gets up, back into the 150 range, where I could sell a 152, a 157, somewhere along those lines, where my risk is more minimal. So every trader can decide what's a proper amount of risk for them. Some traders may look at doing exactly this right now. They may look at selling a 145, for example, right now. If we carry this out to expiration, we can see that if Google did not go up, they could still net $1,400 in profit on this trade. But if Google does go up, this trade starts to hurt really fast. So again, those are some of the different things that traders should look at as a way of adjusting a trade or considering how to manage a trade that goes against you. So I hope you found this helpful, and thanks everyone for tuning in.